And hello, everyone. Welcome to Options Talk, a live market session with the Option Professor. It is February the 5th, 6 p.m. Eastern Time. My name is Daniel Sinning. I will be your moderator throughout the session, and I am greeting you tonight from our beautiful office here in Montreal, in Canada. And before we get into it, let me ask you guys, where are you guys calling in from? Who do we have in the line today? So please put your location into the Q&A box. Who do we have today in our webinar? All right, so let's see who's coming in. Please put your location into the Q&A box of your Zoom window. All right, we do have a full house. I can see this. There we go. All right, Gerald from Santa Fe. Hey, Gerald. Nice to see you. Faiz from Toronto. Oh, right next door. Hey, Faiz, what's up? SK Red from Austin, Texas. Hey there. John from Fort Collins, Colorado. Bester from BEA UK. What's that? Where's that? Is this on the main island of England? Shiraz from London. Another UK guy. Paul from Minneapolis. Hey, Paul, what's up? Nice to see you. Perfect. All right. So Shiraz, I know it's late for you, huh? So thanks so much for staying up this long. Perfect. Well, guys, thank you so much. A truly international crowd once again here at our options webinar. So let's get started. All right, a couple of housekeeping items. First off, this session is being recorded. And the recording will be sent to you shortly afterwards. It will also be posted on our YouTube channel. If you do not know yet where or how to find our YouTube channel, simply go to tradingindicators.com. Top right corner, you will see a YouTube icon. Click on it, and it will bring you right to our YouTube channel where this recording will be posted afterwards. All right. Also, very important, trading options, trading futures, and really any asset class does contain substantial risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you actually can afford to lose. When it comes to backtest performance or hypothetical performance, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and strategies discussed in this webinar should not be construed as trade advice. These are for educational purposes only. All right. So with this out of the way, a quick introduction in case you don't know us yet. So we are tradingindicators.com. As mentioned, my name is Daniel. I'm the guy here on the left-hand side. And about 10 years ago, quite a while back, we are nearing our 10 years anniversary. We have created tradingindicators.com together with Homa here in the middle. And halfway through, Niklas also joined us as our lead of development. And over the years, we've built hundreds, almost thousands of trading indicators, as our name suggests, for clients all over the world. But it didn't stop there. We also have a big focus on education. And today's webinar is going to be fitting right into that emphasis. It's going to be an educational webinar. And for this, I have invited a very special guest today. Of course, you probably already know it. It's the option professor. Jim Kenny is here with us today. He's in the room. And Jim, would you like to say hello to our crowd as well before I
I
talk about the
would.
agenda?
Yeah, sure. Well, we have a lot to cover. It's going to be a very exciting seminar. I'm going to be going over a lot of great information. Background on myself, I've graduated Boston College many years ago, and I went to the UCLA School of Executive Management, and I've been in the option business my entire career. So I was trained at the Options Institute in Chicago, and I've traded thousands and thousands of these contracts in just about all the strategies. So I think I'm a fairly informed source. And what I'm going to try to do, as we do every time, is to try to help you guys trade options a little bit better.
Awesome. Thanks, Jim, for these quick introductions. So Jim is going to be back here in just a second. But let me share with you, what do we have planned for today? So we're going to kick it off. We're going to get right to it with a live market review. So the markets are super interesting, to say the least. And Jim is going to kick it off with his insightful market review. So what's going on right now? Then we're going to cover why you may want to consider options to trade today's markets. We're going to talk about one particular strategy, which may allow you to turn a small account into a big account. So how this strategy looks like, we're going to cover today. We're going to talk about our special options alert service, a coaching option that you can add on, and of course, there will be plenty of time for Q&A. Talking about Q&A, if you guys have any questions or a symbol request, please don't be shy. Put your question into the Q&A box. The more the merrier. The more interaction we have, the better it will be. All right, so if that sounds good, let's get into it. And I'm going to start off with a question to the option professor. So, option professor or Jim, are we on our way to all-time highs in the indexes and blue skies ahead? What's your take on that?
Well, we're on the verge. I would say we're on the verge, and I'll show you some charts when I share my charts on exactly what I think. But clearly, when it goes down, there is a bid. And so it's come back off of drops down to 58.50. It came off a drop of 59.20, and it is having some trouble around 6,000 on the S&P cash. But it is definitely trying to make new highs, and definitely fighting the tape, looking for a big collapse here has not been a big moneymaker, because the drops, while they've been sharp, they've been brief.
Yeah, that's correct. So let's be concrete. Let's look at some charts. So Jim, please take it away and share your screen if you can.
All right, let's go down here to share, and I'll tell you what my tea leaves are telling me.
Yeah.
I emphasize the trend and the momentum. So I know there's 9 million ways. I'm not saying mine is the best. I'm just telling you what I do. So basically, those are the two things I really am interested in. What's the trend of price? And of course, what is the momentum? And then, of course, how far we are from the trends. So let's take a look right here on the S&P. I'm going to the 20-year graph so you can put in perspective where we are. Now, that is obviously a very extended market, right? And we are seeing things change a little bit. So there is some risk here that I'm definitely not going to be unaware of. One is that the JOLTS report now shows a big drop in the amount of jobs available. We already know temporary hires are done. We also know new hires are going at like a 2014 pace. So the only thing missing on employment would be firings. And I'm seeing layoffs on the tape on Bloomberg. This company laying off, this company laying off. And of course, they're supposed to lay off a ton of federal workers. If that unemployment rate started to print 5%, 5.5%, or something like that, that's going to be very problematic for the stock market. The other thing is growth scare. Again, you're seeing some companies like Google come out with very nice earnings, and then they drop 10%. After the close today, Qualcomm came out, boom, quite a bit down. So I don't know if that's telling us something, but certainly you should not be walking around like the man, who just fell to earth, and not be aware that there is going to be a reversion to the mean. The mean would be either the red line, which is like 5,600 or whatever. Then you got green at $5,000, and then you got the full Monty down here to 4,500. Very rarely will it go down to my purple line, only during the crash of COVID. And if it goes down to purple line, you know what Powell will do? He'll set up 14 facilities to buy junk bonds and everything else. So they don't really like it going down that line, but it is possible, as you can see, to hit the blue if things unwound. No evidence of it right this second, but be aware, because obviously one day it will happen. Okay, on the 5-year, again, you've got RSI at 60, and over here you've got it at 63. So it's a little bit of a divergence. One thing I feel about momentum, if it can't get through 60, it's not going to have an acceleration phase. If it's not going to have an acceleration phase, you're staring at the top. So that's why I'm saying we're at a critical juncture. We have no evidence of a rollover. But if we did, be aware that you are slowing down right in that low 60 RSI, which historically can be a top. If we get through here and you start seeing 65, 68, we're probably going up very sharply on the upside. I'll get into the VIX in a second. But now let's go to the 1-year graph, because these are the ones that'll turn first, right? Okay, so we got no turn here, though. Nothing's inverted to the downside. It came down. This is when I was telling people, get on board. That's when you want to do it. And then when it had its correction down into here, that was another place. Right now, we got get above red, which is 60.56, which we're kind of closing on right now. Let's take a look at futures that just opened. And let's see if they've been able to follow through, because Thursday can be a reversal day. And let's see if there's any merit to that, or it can be an acceleration day. So we'll see which one it looks like right now.
I think you put a little extra character there at the beginning.
I did it. Hey, that's why you're a tech expert, and I'm what they call a hack. All right, so there you go.
We all have our roles. So I like to do the technical stuff. You have the market wizard. it works out
we
that
all
way.
have our things we can do. Okay, so it's stalling around here. So be careful tomorrow. What would make me think it'd be problematic tomorrow? Look at the 5-day graph. Again, it looks very good, but it's extended. So there's really nothing here to tell you that it's going to turn over right now. And so, I'm not saying it's going to do that. The 1-day graph, again, if you're a real short-term trader here, what do you have here up there on the RSI? You got 68 or so over here where you're at 59. So you got a divergence. So where would be on the short-term basis, the first break in it would be under 60.88 where we are right now, or 60.80. So let's call it 60.80. Started break underneath 60.80, 60.83. You're going to start rolling this thing down, and there could be your target right here on a short-term basis, and that's at 60.65. So no evidence of a turn just, but I would say it's a little stalled out here, and we know it's an important neighborhood. So be watching it. It could be a propelling neighborhood, or it could be somewhat problematic. Again, Qualcomm's earnings, Skyworks earnings. These stocks are getting hammered pretty good in the aftermarket. Okay, so that was the S&P, and now I'm going to give you the QQQ. This has been a laggard, and it's been a laggard for a while, because the equal weight S&P is doing better than everything because the market is spreading out a bit. Okay, but this thing got off going today, that's for sure. So let's go look at it on a long-term basis so you know where you're at. Again, extended, but still uptrending, obviously. Then what do you got on the 5-year basis? Anything there? Again, you got your double top potential, but it's been holding the blue all the way up, so it's still uptrending. No evidence of a turn. And here again, I think break under 510 and 500, that would be obviously it. But right now, if you're a short-term trader, I don't think you want it underneath 520, and you definitely don't want it under 510. So there's a couple of lines in the sand that I would be using. Okay, and let's turn over to the one that people are really plowing money into, which is the Russell. Russell has some stocks. I was looking at the top 10 movers on the Russell. I mean, just from last week, this is as of Friday's close. They had one stock that was up 200, this for the month, up 220%, another at 156, another one 150, another one 135. So there's some stocks jumping in the Russell. And Russell was very much the place to buy right here. This is your neighborhood right here, right? Right into that vortex. And it's breaking to the upside. So obviously you don't want it underneath 224, and it's only at 229. And so that I would look at that as a very much of a potential breakout on this thing if it can maintain above 224. The other numbers I had as a big deal was 215. You see that? 215, 220. That's a big deal there. Again, closing above 230 is, as I said in my newsletter, very important if you want to make new highs. And if it does that, the new highs could come fast and furious. Now, why did this go up today? I'll give you one reason. I'm going to show you that right now. These guys aren't tariff sensitive, but they are interest rate sensitive because a lot of them are losing money and they got to borrow money. So what do we have here? Let me show you. We got a little bit of a break. I mean, I wouldn't get the party hats out. It's just down 9 ticks. But you see it could go all the way down to 387, and it could go all the way down to 420. And so basically you've got a couple of support zones still underneath that it could go down to and still be in an uptrend for interest rates, yields, uptrend. A couple of the problems with yields is obviously how much debt is going to be issued. Besant just announced that he's going to keep the same policy as Yellen, meaning he's going to keep it on the short-term basis as far as the refundings, at least for the several quarters. Which means he doesn't want to go in there and start messing around with maturity dates, because that could send the yields very much higher if he starts dumping all the short-term maturities and reloading with the 10 and 30-year maturities. That's a lot of supply because we got a $2 trillion deficit. Now, I know Doge is in there trying to find out if somebody cheated on 5 Band-Aids or whatever he's doing down there. But the point is that to really change the situation, you got to hit Medicare, Medicaid, and Social Security. And there ain't nobody in Washington who wants to lose their job by going for that. So a lot of this talk that they're going to do all this cutting, maybe I would bet the other way that they're going to have a hard time making meaningful dents in it unless they attack the big elephants in the room. So there you go. That's why you jumped up here in the Nasdaq. I mean, in the Russell, because they're interest rate sensitive and yields backed off. They've backed off from 480 to 442, so they've backed off pretty good. Now, another reason they backed off is the services ISM came out today, and it showed what? Weakening. So, like I say, that's where the growth scare risk comes in. I mean, come on, we already know nobody's hiring, right? We already know that what do you call? There's a lot of geopolitical unrest. We already know that the earnings are coming out, but a lot of the earnings are being met by sales. I mean, look what happened to AMD yesterday, right? They didn't have a terrible quarter, and they acted like it was a piece of junk. So again, I view those as warning signs, especially when I know I'm on top of Mount Whitney, which is if you look at the 20-year graph, that's what Mount Whitney looks like. Anyway, so that's the story on interest rates. But here's the thing that I find helpful that I'm sharing with you guys, because I'd like you to do as good as you can when you trade. The VIX. Now, when this thing couldn't get above 20 on Monday's crash, and we were on my support zone at 59.27, it was a clear buy. Because if this was really what do you call it, a tariff that was going to stick, well, you think the VIX would have stopped at 20? It would have gone to 25 or 30, and we would have been down through that 59.27 support zone. But that didn't happen. So either somebody or something knew that obviously the market makers made a nice market for everybody panicking on Monday, right at the support zone. Take all your stock in if you're a panicker. They bought it at the low. And now it's right back up again, as usual. And the VIX never got above 20 for any length of time. And now the VIX is trading where? 15. People will invest money when it's under 18, meaning big money will apply to stocks. If you get above 20, you get a buyer's boycott. What does that mean? You're not going to get a guy to put in big money into the stock market when the VIX is above 20. He's going to say, this is too volatile. I got to wait till it settles down. Well, it has settled down, and that's why we've gone from 59.27 to 60.60, right? And we really got to get above this 60.80 area and 6,100 to get going. So this is a neighborhood of resistance. If we can get through there, that'd be great. Can we get through there? Well, according to the VIX, we can, because as long as this VIX is behaved, people will be confident to put money in. And so I watch it very closely, and it's been very helpful in my trading. Okay, so that is the stock indexes and the interest rates and the VIX. Gosh, we're going at a good speed here, huh? How about we look at something like gold? And why would you look at gold? Because we've been positive on gold since it broke above 26.50, and it told us in the short run that it was going up. Now, gold has had a lot of central banks buying. And some people think the central banks have been buying so much to hedge the fact that they've screwed up their currency. I mean, come on, look how much debt and currency has been printed over in China and in Europe and in Japan. So obviously, a lot of these guys are probably saying, we printed a lot of money. I think we better get some gold in there as a hedge. And I think that's what they've been doing. And in the fourth quarter of this year, you got a 51% increase in the pace of purchases in Q4. That's a big jump. So obviously they see Trump coming in here. Now, again, it could very well be that the tariffs are going to be more more bark than bite. I always thought that, because as soon as the S&P drops, Trump called them off. We were down 125 on the S&P, and Trump said, "Oh, I think Mexico, we just resolved it." He doesn't want to see the stock market go down to those other numbers that I showed you on the long-term chart, and that's what they'll do if, in fact, he goes and gets inflation going because of the tariffs. So I think they've worked out a deal where as long as he can go on TV and say, "I won," that satisfies that side of the ledger. And as long as those guys don't get tariffs, then things can go on. So at this point, that's the way it looks to me. It could change, but that seems a reasonable outcome based on Besant being in there, who's a pretty sharp guy, and he knows what happens to markets because he used to work for George Soros as he's the Treasury Secretary, and Trump, who obviously enjoys people liking him, and people don't like you very well when the stock market goes down 20%. Okay, so they're on gold. Let's go over it here. I don't know what I'm looking at here. Here we go. Gold is obviously very extended and overbought, right? That's why I'm not interested in initiating new positions up here. it could go parabolic on you, but it's extended up here. So when should you have gotten in? When it pulls back to the mean, for gosh sakes. And if you have if you're a subscriber of ours and you have any questions on gold or anything else, you call up and go, "Hey, Jim, I understand you follow gold for a long, long time. What do you think of it? What are your charts telling you?" Well, if you came to me today, I'd say, "My chart's telling me you missed the boat." Larry Summers made a good comment. Most mistakes in investing is to do things today that you know you should have done yesterday. Think about that one. That's a pretty savvy comment. So obviously, if you're starting to buy gold now, you're buying it because you know you should have bought it down here.
Or in other
So
words, don't chase the trend.
that's it. That's
Yeah.
it. That's it. But how many times do we think like that? We're doing something because today it looks like it's for sure, but yesterday you had plenty of signals and didn't do it.
Yeah, it all
And
comes
that's
down
really,
to the fear of missing out. So FOMO is
yeah,
seldom a good advisor in trading.
exactly. So anyway, on the gold now, where would you want it to see it pull back and maybe buy again? Well, the red line comes in at what, 2,800 there. So you want it at 27.75, and then underneath that, 27.30, and then 2,700, 27.20. If you can get a 27 handle on it, at least you're buying it at a somewhat a good level. What will bring it down there? I'm not certain, but right now it's a tough place to start entering, unless you put things on a very short leash. And then if you do that, of course, you can enter anytime you want. Okay, so there's the gold. And you can see why we were positive. See, when was I positive? Against the purple, right there, against the purple, against the purple. You want to buy it, then it gets above red and blue. Let's go, let's go, let's go. Okay, if you missed it and you got a pullback, then you go. But just try to do things at the right time. You'll have a happier investing life. And so let's look at crude oil, because that's really on the edge here. Because there's still backwardation going on, which means a tight supply. And there's still unrest all around the world. But let's see what the chart looks like, because I think it's really, yeah, you see? On the 1 year graph, it's on purple. So this thing is in the crunch zone. Comes in at like $70 and change, right? So you don't want it under $70 and change. And this is a heck of a lot better time to buy than 81. Now, on my report, I told everybody that the 60 to 65 neighborhood was a buy. You see, it was against purple down here, and the RSI never got under 40. What does not under 40 means? If you can't get under 40, you're not going to have an acceleration to the upside. If you're not going to have a downside, if you're not going to have an acceleration to the downside, you're probably looking at the bottom.
Yeah. And Jim, real quick, we have got a user question coming in from Scott.
Sure.
He's
Yeah, please
interested,
ask.
he wants to know, what are these averages that you're using? So the purple is the 120 simple moving average. You can see it on top of the chart, the purple little square there. It says SMA 120. And the other ones are just the fastest one is the red one. It's an SMA 12. The green one is the second fastest at SMA 24. The blue one, SMA 36. Then the SMA 120, it's the purple. And then the orange one is the SMA 250. And these are simple moving averages, Chris.
Okay, that's it. I couldn't have said it better myself. Of course, it's like anything else. You can have the right ingredients in the kitchen. That doesn't mean the meal's going to come out right. So the bottom line is you have to learn to interpret this. And if you have a hard time interpreting it, that's why you have a subscription with us and you call up and you go, "Jim, I'd like you to go through this in your coaching session and make me a little bit more familiar on how you interpret it so I can maybe help my trading." And I love to do that. Okay, so again, so after we said this is the lows and it's going to go, it went up to the resistance. I said it's not going to be able to get above 82. Where'd I get that number from? 81, 82. It's right there. I don't make up the numbers. I just read what I got. So obviously selling into there was a great idea, because now we're back to 71. And now we're trying to find out what's the good idea down here. I think we got some evidence that 70 might be good. Do we have any other evidence down here? Let's see what the numbers look like. You got numbers at 73. Yeah, 73. So it's actually a little bit below those numbers, which is not good. But it is holding purple here. If it gets under 65 and 60, you could be looking at $50 crude. So, that could happen. But the bottom line is that, it's down now back into a zone where if it doesn't crack, you got a good looking place to come in. And if this is a year where this is a correction down to 71 and it holds, or 70, these former highs are probably support, right? And so if it holds in here and the purple line pretty much, and then in the month of March and May, as we go into summer driving season, you start hearing 74 or 75, I'd get on the oil train and I'd get on there fast. Because if it takes out 80, I've been telling people this, if it takes out 80, there's nothing up here but white air. And if you start, there's a lot of political stuff going on out there. Not everybody is extremely happy about the Gaza Strip turning into the Riviera of the Middle East. That was not music to many people's ears over there. So, there could be some volatility in that region. And of course, that might affect oil. Let's take a look here at Bitcoin, because I think we've been pretty good on Bitcoin too. Here's how I've been calling the Bitcoin. I've been using a little bit of a longer term chart with the shorter term charts. I like to bounce around. I get a better idea of what's going on. On the 5-year graph, I told everybody, this is your neighborhood. Right in here, that's your neighborhood. And if it breaks above these highs, it's going to fly. Actually, as soon as it broke anywhere above here, it was going to fly. That's what I told people in the report, and that's exactly what happened. Now I've told people at the report that there's support at 90 and resistance at 110, and whichever way it breaks, again, this is now underneath 100. That's not good for this crowd. And if it breaks under 90, can you see we could easily go down to this neighborhood, which would also fill the gap. Now, what made me not believe this last rally is a good old company called MicroStrategy, which we have to now call Strategy, because they decided today to change their name. So I don't know if they'll change the symbol, MSTR. Let's find out. Nope, they haven't changed the symbol yet, but they're called Strategy now. Why? Who knows? These guys issue debt, and then it'd be like if you could borrow money, take all the borrowed money, some of it at zero interest, where you have to pay no interest at all. You take all that borrowed money and just keep buying Bitcoin and Bitcoin and Bitcoin. Well, let me tell you something. That's why I told people in the report, in the long-term options area down here, that the 140 area, okay, and this was even, let me put it on the 1-year graph, it was easier to see even. Yeah, in this 140 area, it was turning up. And if you're bullish on Bitcoin, this is your boy. Why? Because it's leveraged Bitcoin. That's what they own. They own it. And this guy said he's never going to sell. Sales, right? Never going to sell, because it's like Manhattan real estate. It's going to always have a good value, because obviously there's a demand with all the population there. That's the way he plays it. And so far he's been good. But right now I've been noticing that it can't get above 350, and I don't like the way that looks. So I thought it could come down here. If it comes down here, it'll fill the gap. If it comes down here, Bitcoin will be between 65 and 85 grand. And then it might be time to take a bite at the apple, because I'm still a believer that post-halving thing that Tom Lee and all those guys talk about, I think it has some merit, because it has some statistical history. They've done the halving 4 times, 2012, 2016, 2020, 2024. Each time they say, I'm just trusting what I hear, that it's gone up about 300%. Well, we started the last halving at 50 grand. I got basic math skills. 50 grand times 3 is 150 grand. So do I think it could still go there? And maybe by June or July, it could. So that's why there's still a good potential here. But I'll tell you one thing, it's not going to go up to those numbers with MicroStrategy not being able to get above 350. So if I started seeing MicroStrategy at 350, 400, boom, I'd say game on for sure. Right now, I think it's halftime and they're going back to the locker room and take a break. That's what it looks like anyway. But again, when the tape changes, you change. So that's the Bitcoin story and the MicroStrategy story in a nutshell. And, basically that's, I think, most of the markets that we cover. Oh, US dollar, one quick one.
Okay, one last one. Are we going to go back to the slides?
There'd be nothing else to talk about.
Yeah. We're going to look at some concrete stocks, of course.
We've been good on this one too. Let me show you. Go to the 20-year graph. When it's up here, you're going to revert to the mean. That's what I tell people, and that's exactly what it did. Then I go to my 5-year graph, and it hit exactly on my gold line. Whoa, that's why I said it was going to bottom. Now it's come back up here. It's still in an uptrend. It could pull back to 107, I said, which it did. And it also could pull back to 104 if it wants to. But it's clearly in an uptrend. But when our yields drop, it could make this stuff go back down. And one of the reasons it's probably come down from 110 to 107 is our yields on the 10-year went from 480 to 440. If you think the yields are going to 375, this thing is for sure going to 104 in my view. So basically, that's some of the markets. And again, if the dollar does drop, and they don't do tariff, they just threaten it to get soldiers or whatever they're doing, then you could look at a few of these things like this. This is called Europe. And Europe, a lot of gloom over there. And guys like Larry Fink, who runs BlackRock, he thinks it's way overdone. And I've been bullish on this because it looked like it bottomed right there. So Europe could actually surprise people and do quite well. The other area is emerging markets. These guys have currency risk. And if the currency risk can get taken off the table, these as well have got potential. And you can see these look like they may have bottomed when they bottomed against the purple line. At least you got something to defend. And it's got a lot of real estate if it gets going. And then finally, people think Mexico is in big trouble, and they did drop a lot. This thing went from 70 down to $50. Let's see what it's trading today. Yeah, still hanging around here. But again, it's down in this neighborhood here. If it started to get above gold here, that might be telling you that this thing is over, and it certainly is a discount price. So keep an eye on the international markets because there's opportunity all around the world.
Awesome. Well, thanks, Jim, for the great market review. And we're going to get back to the charts in just a bit. Let me just take over the screen for a couple of minutes to talk a little bit about why would anyone consider trading or making investments using options or trades using options. As we will see, there are quite a few good reasons for this. And Jim, I'm just going to take away your screen. 1 second. I'm going to
I did stop share.
Oh, you did. Perfect. All right. Excellent. Okay. So why, let's say MicroStrategy or strategy as it's called now, why would you consider potentially investing into strategy using options instead of doing an outright stock trade? Well, there are actually quite a few reasons for this. And today we're going to focus on the buying side. We're going to buy options. We're not going to sell the option contracts. We are going to buy option contracts. Why would you do this? Well, a wise man once said that your success in the markets is not defined by how much money you make, but by how can you control the money that you lose. And I think there's no better instrument when it comes to, at least in the long direction, there's no better instrument than options for this. Because with options, you do have an exact calculable risk investment. You know exactly how much you can lose for the rest of eternity on this particular trade. It's clearly defined. It's just the option premium that you can lose in these cases. This is what makes options, that's one reason at least why options are so attractive for investments. And on top of this, you can, at least in theory, still make big gains on options on a fixed investment. So it kind of seems like, too good to be true. Now, of course, just like with any craft, the devil is in the detail, and you need to apply certain, I guess, insights to find the right option trades. Because, simply by having these characteristics, limited risk, but potentially big gains, doesn't guarantee by any means that you will be a successful option trader. Because if you just keep losing the premiums, it's not going to do you any good. So there is some, there's a skill involved. And for everyone out there who potentially is new to options trading, or for anyone who is a seasoned option trader, I believe you can still take something away from an options masterclass that Jim and I and Niklas put together during the summer. It's 6 hours of options education from the ground up. So if you're just starting off, it's perfect for you. We're going to start with the basics. But as we continue throughout this masterclass, we're building on our topics, and we're getting more and more advanced and sophisticated. So 6 hours of options education led by Jim, the option professor. And normally we sell it for $397, but today, if you stick around, you can get it completely for free. So if this is of interest, potentially, please stay tuned. So this options masterclass teaching you all the concepts, you can get it for free today. but you need to stay tuned for just a bit more. All right, so this is why you may want to consider options, but let's be concrete. Let's not talk generic terms. Let's take a very precise and exact use case, which may allow you to grow a small account or a small amount into potentially a big account. And this is possible through many different ways, but typically all the different strategies have one thing in common. They're all what we call high reward and low risk, meaning what you potentially can gain will outweigh what you risk on that trade. And especially when it comes to buying options, you know exactly what your risk is. What is it? Well, it is your option premium, the premium that you paid when you purchase the option contracts. That's all you can lose with that trade. So you know exactly what it is. And I believe this is the only instrument where this is the case. Even if, let's say, you buy a stock outright and if your stop loss in place, this doesn't guarantee that you get filled at the stop loss level. What if the market gaps down over the weekend? Well, tough luck. You might get filled at a much worse level than your stop loss. This is not the case of options. With options, regardless of whether there's a gap or not, you will potentially, or the most you can lose is your options premium. So it's very well defined. Now, one of our favorite strategies to potentially grow a small amount into a big one, and which is also considered high reward and low risk, is what's called an options strangle. Yeah, and if you have followed our options report, you know that these strangles are a big part of that options report. Now, you may wonder, hey, what is a strangle? What's an options strangle to begin with? Well, here's a little summary, a little cheat sheet of what an option strangle is all about. And it's pretty cool. So first off, it is what we call a non-directional play. May sound cryptic, but it's actually not. Because by setting up a strangle, you can benefit whether the stock increases or goes down, as long as it moves significantly. That's the only condition. All right. So it's non-directional. Whether it goes up or down, you might benefit from this. That sounds pretty cool. So you don't have to be, sit on a direction where price may go, which oftentimes, especially if big events are happening, like earning reports, are quite unpredictable. You never know if good earnings come out and Google potentially might go up or down. Well, this case it went down. Was that predictable? Probably not. So that's the big benefit of these strangles. These are non-directional. Yeah, whether it goes up or down, you may benefit. And from a technical point of view, a strangle requires buying two types of option: one call option and one put option. And two things here. First off, the expiration date for the call option and the put option is the same. So it's a fixed expiration date, potentially February 21st or March something, whatever. It's the same for the call side and the put side. Secondly, the strike price for the call and the strike price for the put is typically out of the money, meaning for a call, it's a bit above the current price, and for a put, it's below the current price. So both are out of the money. And of course, the further you go out, the cheaper the option contracts will be, because the less likely it is that price will actually move all the way towards the strike price. All right. Now, the idea is that if we find a stock which moves significantly after we have purchased the strangle, we can benefit from this, whether it's to the upside or the downside. Our risk, however, will always be fixed. It's simply the cost of the premiums for the call option and the put option. So that's the idea. And I believe, and of course, the reward, potentially at least, in theory, is unlimited. Of course, in practicality, it's not the case, but you can still potentially gain a lot. We're going to see some examples of this in just a bit. Now, do you think that sounds easy? Well, I guess at first glance, it may sound super easy and you may say, hey, of course, a strangle. I can benefit whether the stock goes up or down. Sounds great. Well, not so fast, because actually, and in real life, for a strangle to work, your timing and also the setup that you are using are paramount. Meaning, if your timing is off, if you buy, let's say, the two options, the call option and the put option, at the moment where potentially the option contracts are already very expensive. They're already priced in the upcoming volatility. That's not a good idea. So just like with anything, if you buy something, you want to buy it as cheap as possible. Yeah. So timing is key when to buy these contracts because you want to buy them when the volatility or implied volatility is low and expected to rise in the future. That's the idea. That's one thing that you need to get right. And the second thing, you also have to be clever about choosing your expiration date for these contracts and your strike prices. How far should I go out of the money for my call contract? Meaning, how far above price should it be? Or for the put contract, how far below price should it be? These need to be wisely chosen as well. If you get these two things wrong, chances are this strangle will not work at all. So there's a lot of skill involved. And before we look at some examples, do you want to add anything to my little theory lesson here on strangles? And what
Yeah,
is
I
it?
mean, you're hitting you're hitting the most points. That's why it takes hours and hours and hours to go through the stocks each week to try to find ones where A, the chart formations seem favorable, B, that premiums are not already discounting what I think might happen, and C, that there is some type of news or event that could occur to stimulate the volatility that we're looking for. So there's a few different things you have to put together, and it's not on every street corner.
That's correct. It takes a lot of research. But if you are right, if you get your strangle right, you can hit some really astonishing results. So here are some examples of some of the recent strangles that we put out in our option alert. And Jim, perhaps maybe you talk about a couple of those which we released lately and how they turned out.
Yeah, well, JP Morgan was one that really jumped out because it was in a very nice consolidation range between 240 and 245, and it had earnings coming out. So in the late December timeframe, I went out and I said the January 31 expiration strangle 255 and 220 was about $300. And I said to myself, these guys are going to announce earnings. What are they going to announce? If they're losing money? I mean, JP Morgan makes money. And so when that happens, and of course, this is supposed to be the year of the financial company because of the deregulation. It's supposed to be wild, wild west, and all that money that they have to put into compliance, they can now put it into loans and other things. So it's a huge deregulation play as well. And there's no question between Besant and Trump and Lupnick and everybody else in his neighborhood. They don't want any police out there. So boom, this is a tailor-made for this JP Morgan company. So the stock went up to $270 before expiration, which means the options went from $300 up to $1,500, and that's a pretty darn good run. So that was the reasoning behind it. That is when shall we say research and instinct and a good earnings report is the combination that can really make you a lot of money. The other ones, Apple and Google, these guys were on the defensive. I mean, Google was way down there in the 160, 170 area, and Apple was down there in the 225 area. This was before they had their last drop, obviously. And so there was a couple of times where we could take a shot that they would rally because that's the way the tea leaves were showing. And Google was lovely because those options were dirt cheap because you see Google stayed in a range. 160, 175, 160, 175 for a while. Hey, listen, there's a thing called implied volatility, guys. What it means is you're going to pay for whatever has just happened. So if nothing's been going on, you're going to pay nothing. And then if something goes on that they're not expecting in the price, it's going to expand dramatically. And if you want to know what dramatically looks like, look at the Google plays there. Very reasonable entries. I mean, if you can get a decent deal going for Google and Apple for in the 300 or 200 area, I mean, I think that's pretty good bargain city because mostly they're much more expensive. But sometimes, like all of them, they go on to sale. Like NVIDIA is supposed to be God's gift, right? Stock's gone from 150 down to 113. And I'll show you what I'm thinking about that in a minute because I know a lot of you guys have interest. But, listen, even the golden goose, gets some mud on the uniform.
Exactly. And guys, just one more thing about what I said about timing needs to be right and the setup needs to be right. So you need to choose when it's a good time to buy these strangles. Because as Jim said, only sometimes. You have to do your research. You will find like gems in quotes like this where option prices are very reasonable. Yeah, like with Google or Apple here. This is not the case all the time. So you need to have the right moment when to set up the strangle. And on top of this, you need to know where to place your strike prices and what should be the expiration. So all these things need to come together for a successful strangle. Now, if this sounds complicated, this perhaps does, because you may ask yourself the question, hey, how would I know when to buy Google or Apple, or where should I put my strike price on my expiration? Well, we do have a solution for this, guys. We have an alert service where Jim every single week, like clockwork, will give you his, or the option professor will give you his research report on the most interesting option plays that he sees. So this report includes a whole bunch of strangle trades, which are typically more of a short-term trade, because the expiration is not too far out. And if things work out, you may see returns very soon, within a week or a bit more. So that's part of this option alert service. And there's weeks, or not weeks, hours of research and experience included in these distilled reports. And how these look like, I'm going to show you in a second. So strangles are included. The option professor's outlook on the indexes, the S&P 500, NASDAQ, Russell is included as well. Where are important support zones, where are targets and stop losses if needed. And to top things off, also longer term directional plays are included, which are kind of your home run option trades if things work out. They are more of a speculative side. Expirations are further out. They're not too expensive because expirations are quite far out. But if you are right, you might be in for a really nice, I guess, run for these ones as well. So we call these the options triple play alerts. Now, if you are interested, we're going to get to the charts in just a second, so please stay with me for just a bit. If you're interested, this is how it looks like. I just picked a random report here from November. Actually, this is the one from actually more recently from this week, where Jim starts things off with a market review. What has transpired in the last couple of weeks and days, and what has happened to how did it affect the current market situation? So you see all these things are written up, but of course, most importantly, you will also get served on a silver platter, so to say, how to set up these strangle ideas that the option professor has put out. So for example, for the Apple strangle, the one that really worked out nicely here, which one? This one here, you see exactly how to play it. In the alert, you will see, all right, for the Apple strangle, set up a strangle with a call contract at a strike of 237.5 and the put 217.5. The approximate cost, $320. Of course, that depends on your broker. And the expiration for these two contracts should be December 20th. So this is all you need to know to put on this trade with your broker if you decide to do so. In addition to this, you get the market commentary, you know which sector this trade plays in, because you don't want to overexpose yourself to a certain sector. You want to diversify, of course. Everything you need to make an insightful decision on these alerts. So this is part of our options alert service. So it's very easy to follow. And if you combine this with our options masterclass, it can be a great starting point to learn more about options, to get exposed to the topic, and of course, potentially to benefit from those in the long run. All right. So these are the alerts, and I'm going to get back to the slides, but I'd like to point out that we do have a very special offer prepared for you today. So, and remember when I said in the beginning, you can get this free masterclass. Well, we're going to throw in this free option masterclass, these 6 hours of options training. It's all recorded. It's distilled in 3 concise lessons, 2 hours approximately each, led by the option professor and myself. So typically we sell it at $397, but today it's going to be completely free if you decide to come on board. And the link for this is tradingindicators.com/alerts. And let me put this link into the chat real quick. And Jim, would you like to expand a little bit on this topic? Where I type in the link?
The options masterclass is very, very helpful, I think, to all levels of traders, but certainly the ones starting out. And I think the best thing about it is if there's any questions on it, And this is an online class, so you can do a little bit of it, stop, go back, go forth, take a note. You can call me up and say, Jim, I'm watching session 2, and you're talking about spreads, and you're giving your opinions how to trade spreads. Or Jim, you're showing how you would like to trade short-term options or how to do that. Whatever the question, you can talk to me directly, and I can go, what exactly are you questioning? Let's answer it. Let's make sure you're comfortable. And then when you hang up the phone, that part of your challenge is resolved. So it's a very good thing to get a great course, but also talk to the person who's on it with any question you might have.
Yeah, absolutely. But guys, it even gets better. So, in addition to this, of course, you're going to get the options masterclass. We do have a super special offer, which is available with the quarterly package that we offer. Because for this one, you will not only get the masterclass, but you will also get 1 hour of personal coaching led or by the option professor. This is one-on-one on the phone or Zoom with the option professor, and you can discuss any topic you want. You can bounce off ideas. You can review a trade that you currently have on or perhaps considering. I think it's a great resource, which we are adding to this package if you decide for the quarterly package. And real quick before Jim can expand on this, we essentially have 2 packages for you. There's the monthly option and the quarterly one. The quarterly one being I believe, the best buck or the best value for your buck. So the monthly has the 6-hour options masterclass included. We're discounting the first month by $100. You can see the price here. But for the quarterly, you will not only get the first quarter discounted, but you will also get the 1 hour of free and complimentary coaching led by the option professor or by the option professor, one-on-one coaching. And of course, you get the 6-hour options masterclass as well. So tradingindicators.com/alerts for these 2 options. And as I said, the second one here, the quarterly, is probably the best value for your money. All right. So with this, Jim, should we go back to the chart and review some perhaps some concrete stocks?
Yeah, I was going to review because a lot of people are interested in short term.
Oh, you just dropped off for a second.
Here we go. No, I'm good. I'm good.
Okay.
I got a fussy headset.
It's all good. We can hear you.
Okay.
There we go. Okay. Perfect.
All right. Daniel, if it's okay, what I'd like to do is a lot of people are into short-term trading and a lot of people are into credit spreads. So why don't I give a little examples of how I can help people during the coaching sessions or even through the course that they get on how they could do that. Now, Newmont Mining, okay, if you're going to do short-term trading, you look at your short-term graphs. So this thing has been going very well all year long. And basically in the last 5 days, it's really given me that it has another leg up. So I was very positive on this because I think gold's obviously going up during that time. So I thought this was a great place to go. Now I'll show you what the option prices are. If you came in on Monday and you bought some of these things just today, to give you an idea. These expire on Friday. And check a look at the jump in them. The $45, these calls here. I mean, you could have bought very inexpensive options. This option here that's it's up 105. That means you could have bought it for like 60 cents, 50 cents, 60 cents. The thing's at $1.60. Who doesn't have $60 to take a chance on something, right? And obviously, who's to say it's going to stop here? The thing finished right on the highs. So that gives you some of the idea of the percentage moves you can get on short-term options if you're correct. So obviously the key is be correct by using the short-term graphs, see something that's going, and obviously look for it to continue. If it continues, you're going to get paid. If it doesn't continue, the premiums are not going to kill you, right? So that's Newmont Mining. I look at the ones that have done good for the first month of January, and I'm thinking they might continue to do good, right? Because a body in motion tends to stay in motion sometimes, right? So I'll give you another one here that looked pretty good, and that's EQT. EQT. And this one's been doing good in the month of January. So you could have come in now in February and said, you know what, I think it looks like it might keep going. So I'm going to take a shot on it here. And here's the ones that expire on Friday. This is just the move from today, just the move from today. And those are pretty healthy moves, 50% in one day. You know, and who knows if it's going to keep going, but that one's got some momentum. Another one is ANET. And Arista Networks. And that's been a good company for a long time. Went into the year very strong, up in the month of January, very good. And you can see short-term options there popping very nicely today because a body in motion has been staying in motion. If it didn't, you wouldn't make money. So that's the risk. But the risk you're taking on some of these premiums, you can't even go out and get a steak dinner. Let me give you a couple more examples. So if you're short-term trading, you know, obviously I keep an eye on some of these things. This one here is down in the aftermarket, but it had a pretty good day today, that's for sure. And it's been kind of going up here. So this is ARM. It's been doing very good in the month of January. So you think maybe it'll keep going. And it's down in the aftermarket, but you know, why wouldn't you have taken some profits on these things today? I mean, in one day, if somebody tells you made 162%, you're not going to grab any money. So, you know, that's not bad looking green. Now, obviously, they must have come out with earnings or something. And this is my point. Good companies are going down, which means there is a risk to the market. Be careful. Okay, let me show you a couple more here real quick. Marvel. Ooh, yeah. Now that one is one you want to be checking out if you came out. See, again, after January, they had a great month, up about 10% or so or more for the month of January, 1 month gain. That tells me it's moving, right? Well, not only did it move, but this one here, I mean, come on, in one day, it's up 275 points, and these are pretty cheap options. So, you know, if you want to play short-term options that don't cost much, the key is obviously timing and momentum. And if you're any good at that, you know, there's plenty of things you can do. And if you're wrong and you don't go crazy, I always tell people trade small. You'll be around a lot longer. And when you're right, you're going to be very right. And if you're wrong, it's not going to hurt that bad. That's not so bad. Another one here was Starbucks. That had a pretty good beginning of the year. And they have a new guy in there, right? The guy from Chipotle. Looks like he's doing a pretty good job. And today it started to get on the move a little bit here. And you had some pretty good one-day pops, 145%, 100% in a day. And they're cheap options. So, you know, if you are a short-term, you know, 0 to expiration, 3 days to expiration kind of guy, you got to find the ones that have momentum or else you can't make any money. LRCX, Lam Research, had a good January, looking for a body to stay in motion, And as you can see from today, nice little pop. And so it's not so bad. So again, that's the way I would try to work with people who are trying to do short-term options, to try to come up with a schematic where you can find where that momentum is going to be and try to take your shot when you got a reasonable expectation that it could get a run during the week you're trying to play ball. And so again, when you're a subscriber, if you have a question on something like this, all you got to do is text me and we set up a time and we just do our thing. I'll have this chart up. You'll have the chart up as well. We'll talk turkey and try to help you improve your results. Perfect. All right, I am going to show you the credit put spreads, which everybody loves to do.
Jim,
and show you where the danger, huh?
Jim, real quick, because we got some questions coming in before you put up this chart. Who was it? Jerry wants to know when are these alerts coming out? Good question. I didn't talk about this yet. They are coming out every single Sunday afternoon. You have to get them straight to your inbox. It's a distilled report. It's also in PDF form available. You can get in your email, but also as a PDF. And in there, you have all these strangle ideas, the long-term plays, and also the index ideas distilled. And what I do, then of course, I peruse all these things, and me as a user in this case, I peruse all these and I pick my gems which resonate the most with me. I do a bit of I look at the chart and say, hey, this is an interesting one. This is an interesting one, and this one. And then when the market opens on Monday, and if prices are still similar to what's indicated in the report, and things are still lined up to what the expectation is, yeah, then I just place the trade. And it's easy as this because all the heavy lifting, I should say it, has been done to you by the option professor. That's a great time saver. And as you saw before, there are some real gems among those alerts.
Yeah, and I'll show you this stock here. About a month ago, we put it on the report, and you can see it's certainly not been a shrinking violet. This is a KD, and you can see that's on a 5-year graph. You want a more dramatic view, look at this graph. So again, it came down here to the line. We thought it might be good, and apparently it was very good. So there's a couple other ones that I didn't mention. I want to mention them to you. One is Boeing. And I think Boeing's got a good looking chart. And you know, they got a lot of orders. It reminds me of SoundHound when SoundHound was at $4 or $5, and I go, these guys got $500 million worth of orders to fill. They're going to be making money. Next thing I knew, SoundHound's $24. These guys got nothing but orders to fill. And look at that chart on the 1 year. I mean, does that thing look like it could explode to the upside? So I took a shot. You know, these are ones that I did personally. So full disclosure, but I didn't think it's going to get under 175. And I think it's going to, you know, I went out a few months and basically I think it could go to 200 or 220 on a run. And, you know, the options I bought a little bit out of the money, you know, are pretty darn cheap. And they're not going to be very cheap if this thing goes up to 200. So I don't know if it's going to do that, but it's certainly pointing in that direction. And, you know, that's how you can try to make money, is you say, okay, they've had 2 shots at the apple to break the blue line, never could. The blue line, the red line, the green line are pointing up. They got plenty of business on the books. What's their problem? They're having a hard time putting this stuff together and delivering the airplanes. Well, I'm sure they're in the process of figuring that out. And, you know, you're not look at when the bottom hit here, because this is a very good thing. So I said to myself, and I don't know if I'm going to be right or not, but on the 20-year graph here, this goes back 20 years. It hit the gold line. So I think 140 and 150 is it. Well, if 150 is it and it's only at 170, you know, I don't think going up to the purple line here at 220 on some good news is off the chart. And believe me, the stuff that I bought, if it goes up to 220, there'll be a lot of filet mignon in the freezer. So that's one. And then we have a natural gas stock, which I think has a very good potential. And this is called Range Resources. And if you look at this graph here, and I don't know what's going to happen, that's why there's a risk. But does this thing look like it wants to go down? I mean, it's held the blue line lovely. It's got the red line tilting up. It's above gold now. So as long as this stays above gold, which is $36, which coincidentally was the low on the correction about, I think if it takes out 40, $45, you know, and something happens with the gas supplies, who knows in this crazy world, right? You could get this thing to fly like an eagle, and the options are still pretty cheap in my view. So that's another one that I think could be something to keep an eye on.
Actually, that's Jim. Real quick, little side story. That's the one I picked, for example, for myself on Monday. As I mentioned, I'm also a user of Jim's reports. They're awesome, and I put on this trade, and it's well in profit right now. So happy with that one so far. I think there's more to come.
Yeah. Now I'm going to talk a little bit about the credit put spreads, because I know it's popular. First of all, let me tell you about credit put spreads. They're lovely. Why? Because they're limited risk, and statistically, they've got a very good probability of working. That's why they're lovely. You know why they're not lovely? They only give you a limited gain. And if you're ever wrong on them, not only are they going to probably wipe out your limited gains, but they're probably going to nail your principal. So it's very important you don't make mistakes, because oh, it wins 9 out of 10 times. It wins 8 out of 10 times. Well, how do they do in those other one time? Well, we had to buy the whole spread back for the full price of 10. We were taking in 1/4 of a point and 1 point. So we took in 3 points and we lost 10. That's down 7. Not good. So why you got to be careful? You got to be careful because if you do it at the wrong time, you're going to get whacked. Tesla. Everyone loves Tesla. I'm selling puts on Tesla. I'm selling puts. I make money every month selling puts on Tesla. Well, you know, you had a good deal going for a long time. Let me show you what it looked like. Okay, this thing bottomed out down here. So ever since 240, You could have been selling puts underneath the red line pretty much, or at the green line pretty much for a long time. Can you see there's been some deterioration since then, though? Because you see, this is when everybody thought Musk was going to be the vice president or whatever he's doing down there. He was living at Mar-Lago, living at Mar-Lago. So obviously, and he has a lot of projects down there. Now, this is obviously not a car company. How do you know it's not a car company? Because they sell less cars year over year. So how the heck do your stock go up like that if you're a car company that's selling less cars than the year prior? Now, what it is, it's a space company. It's a Starlink company. It is all kinds of companies. Now, I don't even know if you get any credit, but the main thing it's self-driving vehicles company, and it's a self-driving taxi company, of which he's convinced the world that he's going to be supplying the entire planet with a bunch of these cars where nobody's in them, and they just go 24 hours a day with no employees. And if that's the way it works out, maybe the stock is worth that and then 3 times what it's worth now. But if it doesn't happen, then you're going to go back down to the purple line. Okay. And maybe even the gold line, who knows? But if you're selling puts, like you've been selling puts and having such a lovely time of it, obviously you haven't had a lovely time here. Then you got a little reprieve. Now you're not having a lovely time now. Now, the scary part is it could go into the abyss. It's holding on to this double, triple bottom here, but if it fails, it's problems. And green is pointing down and red is pointing down. So it's not a great setup. I wouldn't sell puts here with found money. Why? Because it's dangerous. It's dangerous. Look at the 1 month graph. There's nothing to tell me that it's turning. Now, if it started to get above 3, I always said, if it gets above 410, sell all the puts you want. But right now, that's not the case. So, if it got above 410, then of course I would change my tune, because then I would think it's back in the uptrend. You see the 400 there and then the 420. So call it 400, 420. You get above there, then you can sell all your puts you want right underneath 380. But right now you should be white knuckled, because this thing could easily have a big drop. His popularity is not growing down there, slashing expenditures, looking for Medicare fraud or whatever he's doing down there. It's not for he's a jolly good fellow when he's doing that kind of stuff. So maybe his popularity could wane a little bit. I don't know. But I wouldn't do the puts there. Okay. Now, where would I do the puts? That's a good question, Jim. Why don't you help me with that one? How about NVIDIA? Why NVIDIA, Jim? I'll show you. And all you got to do is be patient and wait for the things to come back to you. When they come back to you, you do it. Okay. Now, you look at the graph. You see that? People go, "Oh, Jim, what do you think of NVIDIA?" I go, "I think nothing of it until it gets back above 130 or it gets down to 113, 115. Well, it got down to 113, 115, right? And that's when you start buying calls, which is so far so good. Buying call spreads, so far so good. They got earnings coming out on the 26th. Seems like those companies are spending an awful lot of money and plan to spend more. And Supermicro Computer says that they're ready to move with the chips and the platform, whatever else they're doing. So the news is changing a bit for them as well. So again, here you have a line in the sand to defend. If you, when it was down here, you could have sold 105s, 100s, 90s, probably got paid for all that kind of stuff. And now your risk is if it goes up, you win. If it goes sideways, you win. If it goes down, you win, as long as it stays above whatever strike you picked down here. That was the time to do your credit put spreads. That's what I told people if they were interested. This is a high probability area. That's the difference between somebody who's done it for 20, 30, whatever years. It's getting scary how many years. And somebody who is, read a book from the Nigerian brothers and wants to go attack the option market, right? So I try to help people avoid problems. And that's a big part of investing, just avoiding problems, but I also try to help them with regards to, their timing. And there's so much I can help you with as far as, when you buy an option and it goes up. Let me give you a quick example on that.
Maybe one more example, Jim, then we're going to bring the offer back on, because I have a whole bunch of questions regarding to that.
One more example on the what?
And then, you said you wanted to do one more chart example?
Hang on.
Yep.
1 second. Daniel?
Yeah. Hi.
Okay, I got you now. What did you say? Another example on?
Let's do one more example, and then we're going to go back to the slides because I have a whole bunch of questions regarding our offer here. So
Okay,
we're going to get to
no
that.
problem. That's a good idea. And like I say, although I'd love to divulge all my information in an hour, it just can't be done. And I think you're hearing that, right? Yeah. So again, one more example on what were we doing?
Let's do Apple.
Okay.
Guys, if you have any questions or symbol requests, please don't be shy.
Okay, on Apple, again, not any great time to do much of anything here, except right here. Okay, so here you could say to yourself, I'm going to defend this point, this blue line, which comes in at 230, 228, and the low is like 225. So if you wanted to defend that, you could sell your puts underneath and then obviously keep the premium as long as it stays above the blue line. But I wouldn't wait for them to go way in the money before I bought them back. You know what I mean? You know, I have exit strategies that I do on these type of strategies, which I can share during the coaching session. But believe me, you don't want them to go deep in the money and then be hoping it has a rally or else lose the whole premium. You should be either closing them down or rolling them out at a certain point. But your first point is you have to have something to defend.
Yeah, good point. Yeah, so
Do you want
timing
me
is,
to?
yeah,
Yeah.
please, yeah, I just want to say, timing is everything. And of course, the technicals also matter so much when you put on your option trades, because ideally, as Jim said, they should be at a key and crucial technical level, something to defend, a support level, for example, or one of these moving averages that Jim has been talking about. All right, so let me quickly bring back my slides. There we go. And let's go through some of the questions. For example, thanks, guys, for all these questions. Let me do some symbol requests here too. All right. So Chris wants to know, and this relates to our, what is it? One second. If I find it. There we go. To our medium to long-term directional plays. And his question was, and maybe Jim, you can comment on this as well. How do we find, one second. Yeah, how do you choose these strike prices for those long-term prices, long-term alerts, and the expiration that should go into? Do you have any secret sauce for this, or what's your take on this? Is it just your experience that you use, or your technical outlook on the symbol? But how do you find for
Yeah,
these
I mean,
longer term? Yeah,
I like thematics. In other words, you know, I've been very bullish on the financials because they're deregulating everything, right? So obviously that would be an area that I would not mind buying 6 or 12-month options when the prices were down on things like Wells Fargo, Citigroup, you know the names, JP Morgan, right? Those guys are going to go up if deregulation hits. And so when the prices were down, you know, you take a long-term position. MicroStrategy, when I could see that the Bitcoin was breaking out and MicroStrategy was turning up at 150, I had no problem going out to September of this year and going with a 140, 180 call spread or a 180, 220 call spread, trying to make $4 grand on a grand. And obviously, if it goes to 550 like it did, you can blow it out way before the expiration date. I don't have any trouble when they bring a guy in from Chipotle who just seems to be a good guy, and I can see, Starbucks is in the 70s, and I know that everyone's hooked on their product. I mean, it's an addictive product. What are you going to stop drinking coffee in this day and age? Yeah, you need coffee just to exist. So the bottom line is that I thought that was a great long-term play that's working good. Palantir. I mean, I've owned Palantir since it was very cheap. I mean, they got government contracts. Government certainly likes to snoop on people, and that's what they do for work. Plus, the guy Peter Thiel gave Trump a ton of money. Trump obviously returns favors to people if you obviously funded his campaign. So basically, what was he going to tell Peter Thiel? I'm not going to do business with you. So Palantir has nothing but contracts coming in, and they have, like the guy says, what was it? Insane demand for his stuff. So at $31, we put that on the alert. The thing's at $100 now. So I try to find things, and not all going to work like that. But what you're trying to find is things that have a very bright future, where the price is somewhat fair, and then you go out in time. And so basically, and even like NVIDIA down here at 113. You don't think you can go back to 150, 180 once they start announcing earnings? And if 75 billion from Google in CapEx spend, they're up 40%, these guys. They're adding 40% to last year's monster numbers. So we don't have to worry. They're not getting any value out of it. Microsoft's actually down in price. Google's down in price because people are figuring out they're probably overspending, but they feel compelled to do it. And so who do you want to go to is where they're going to spend that money. And so wherever they're going to spend that money would obviously be companies that might make a lot of money. And so that's where my mentality goes when I'm trying to come up with long-term options.
Awesome. Thanks, Jim. A couple of technical questions, more regarding to my end here. So for those of you who came on board and just got the question here in the chat, what you can expect right after you sign up. First off, you will get a welcome email welcoming us to the service, and you will get immediate access to our options masterclass. So that's what you're going to get right away. Also, I will send you last Sunday's alert. Today is Wednesday, so a little bit old, but I'm going to send them to you anyways, so you can get used to them, you can peruse them and see what you can expect. And then, of course, starting from this Sunday, every Sunday afternoon, you can expect in your inbox the fresh alerts for the week ahead. So that's the process for all of you. Perfect. All right. John wants to know, it's getting late in the UK, I believe. Is that where you are? Can you send me the recording afterwards? So, John, yes, I'm going to note down your email address. Give me 1 second. Let me just put this into my notepad here. 1 second. I'm going to send it to you afterwards. You can also find it, John, afterwards on our YouTube page. We're going to upload it there. Yeah, go to tradingindicators.com, click on the YouTube icon, top right corner, and you can see the recording right there as well. All right. Yes, Robert, a good question. So he said he is not on the quarterly option, but he wants to get some coaching anyways. And Robert, we do have an option for this as well. It's called Meet the Option Professor. Robert, I'm going to send you an email shortly afterwards on how you can take advantage of this. So that's the service we have as well. So thanks for asking. You can expect an email from me shortly after this session. Perfect. All right. Okay, so guys, just to repeat, this is a special offer for a limited time. We're gonna throw in the personal coaching, one-on-one coaching by Jim, the option professor. I think a great opportunity to pick his brain for any topic that you have in mind. So trading related, maybe strategic outlooks, perhaps a particular trade that you currently have open and you have questions on how to manage it, how to perhaps roll it to other different strike prices and so forth. So all these are possible in the coaching session. And Jim, let me ask you a question. It's actually a great segue. How do you coach your students? Do you have any particular approach, or what do you do on these coaching sessions?
The first thing I do is listen. And so when people come to me, I call them friends, because you're a customer, you're a friend. So when my friends call me up and they go, I got a question on this. I'm doing this kind of trading. I'm doing that kind of trading. One guy said, I keep doing credit spreads. I win a little bit, then I lose. I win a bit, then I lose. Well, let's look at that and let's see how I can help you improve that. And so basically I listen, and then you tell me what you need, what you'd like to know, what you're currently doing that you'd like to do better. And I give you my view and my opinion on how I would do it better. And like I say, I'm not perfect, but I certainly have knowledge and I certainly have experience. And so it's not the worst thing to do to bring bring your questions and your challenges to somebody who's been in the game for a very long time.
Thanks, Jim. That's a great answer. And another question for you, Jim. Which questions do you usually get from your students? Do you have any examples, or just to perhaps?
Well, like I say, a lot of the questions come from I've never dealt in options before, so we start with the basics. Here's a call, here's a put. Let's look at a stock. Let me show you, if you wanted to buy a call, how I would pick which call to buy, how far out I would go based on what we're seeing technically. And then basically, if it moves in your direction, what your next move would be. If it moves against you, what your next move would be. So we start with the basics of call, put. Then a lot of questions come in with I'm doing short-term trading and I'm not doing well, so I'd like to do better. How would you do things better? And a lot of them with the credit spreads, with this, because again, these credit spreads work most of the time, but when they don't work, you're back to square one, and all you are is older with a bunch of headaches from it. So, if you're going to do that, and there's plenty of other strategies, cash secured puts, where you sell puts to accumulate stock at a discount or keep the premium. Covered calls, where you're going to sell calls against your stock so you can generate cash. And I think one of the biggest things up here, I mean, for gosh sake, we're at 6,100 on the S&P. Hedging, replacement trades. How does hedging work? Well, you could do some selling of calls and buy puts to bracket your position, or you could replace it with call spreads and keep the rest of the money in your pocket safe. If it keeps going, you've got a position. If it goes way down, you got that big load of dough in your pocket because you took it off the table, but you still had something to make money if it kept going. So these are the things, you bring me your questions, and I've done much more than just options in my investing career. So I have knowledge of many different things, but I do know how to use the options on both an offensive way, meaning speculative way, and also as a defensive way, meaning a protecting positions way. And again, I'm very big on, the reason we like to do the strangles that don't cost much is because, you want to keep the risk, in dollar terms as reasonable as possible so that you obviously manage your bankroll properly. So you can do it a very long time, because we don't know when's the big month, like August of this last year when the Japan trade came in and we dropped 500 points on the S&P. Nor did we know, that it might jump up 500 points after Trump was winning. So there's always going to be something out there. You want to be around for it. I mean, Merck just came out of the blue and dumped all kinds of an amount, ADM. So you want to be around, like I say, and that's why trade small and and try to keep the premiums you pay when you're buying them at a reasonable amount.
Perfect. Yeah. Thanks, Jim. So guys, now it's time for Q&A. And if you have any questions, please put them into the Q&A box of your Zoom window. And I do see some symbol requests here. So we have AI, the symbol AI to look into. We have NVIDIA. One more time, here's a quick recap of what we saw on NVIDIA from Faiz. And yeah, and Robert, I'm going to get back to you. So don't worry about this. I'm going to send you an email afterwards. Perfect. So it's good to have you back, Robert. All right. So guys, please put your questions into the Q&A box. And while you do, for those of you who have signed up already, thanks so much. I can see all of you so far have picked the quarterly option. No big surprise there. I think I agree. That's by far the best value for your money, because you get this 1 hour.
If you have basic math skills, it's definitely the best one.
Yeah. Absolutely.
Because you're getting the free course and you're getting an hour free coaching, which generally goes for $200 an hour. So obviously you put those two freebies together and you're way down the field as far as 297.
Perfect. All right, Jim, are you available for perhaps 2 or 3 more symbols to review on the chart?
Sure. You want me to come back in here?
Please go ahead.
All right. Well, I hit something here. I lost your screen.
Oh, should be somewhere. Maybe find the Zoom icon and your tray down there.
No.
If not, I can put it up myself too. That's fine.
Yeah, I wonder what happened there, though. Huh.
If you want,
mine says post attendee. Mine says, should it say post attendee on the top?
No, maybe that's probably the wrong option. Maybe you can get out of there and click share one more time. Sorry, guys, just 1 second until we are figuring this out.
Ooh. Hang on 1 second.
And while you do, I'm going to answer a question by Jay. He wants to know, so how do we find options which are actually liquid, where there's enough liquidity, where the spreads are not crazy wide? Great question. So all the alerts that we are putting out, they are only for liquid stocks. So that by default is built in. And he's also wondering, which broker do you recommend? So I know Jim, I forgot what Jim is using, but I personally use Interactive Brokers. They have a great option package. It's very liquid, and they have millions of clients. One of the biggest brokers out there. So that's what I use. It works great, especially if that new platform, that new Traders Workstation, it has a different name now. It's much better than the old one. The old one was so clunky. But with the new one, it's really nice. You have, yeah, you have different ways to visualize your options trade, your risk, and so forth. So I use Interactive Brokers. I'm happy with them, for example. So Jim, I see your screen is up.
I'm just a problem solver, Daniel. I'm a problem solver. All right, give me a symbol, AI, hey?
AI, yes. And I'm going to answer some questions in the chat here in the meantime.
All right. I always start with a 20-year, so I'm going to start out wide. This may not have been around very long, so might not matter. In the 20-year, it's well, it looks like it's based out down there. Let's see about the 5-year. Yeah, like I say, it's constructive. It looks like it wants to go. Right now, you want it to stay above $26, $29, and $30. So anywhere between 27 and 30, you want it to stay above. It really, if it gets above the red line, you should be home free. The red line comes in at 35.50. So you got one more hurdle. Now let's see about the 1-year. Yeah, well, this is where you should have got it. It's $30 right here, right? Pretty obvious. And now you are running into a little bit of a problem here. So I'd be careful. 35.50, we know there's a little resistance there. We got the blue line here coming in at what? 30. Oh, it looks like it's 30.
Yeah.
Yeah, like just above here. 35.50 is clearly an important number. I don't like the blue line pointing down. Do I like this bounce? This was a good trade. If you would have got it down here and did a 1 week or 2 week option, you made a nice little fortune because you took a shot when no one was buying calls. The calls were dirt cheap. You stuck your head in there because you knew you had something to defend, and now you know you should be taking your profit because it's hitting the blue line. That was the trade. That was the one I'd be interested in. Here, you're hoping it breaks out above 35.50, which it looks like it could do because, again, if it gets going from the 5-year graph, there is a lot of real estate above. So, this one might be something that you'd buy the 40 calls, go out till September and sit on them and just see if this is your year. To give you an idea how cheap some of these things are. I mean, why play the short term? This thing looks like it could be a home run if it starts going, right? And again, do they get the money from the hyperscalers? If they do, then it's a decent bet. Now, if I go out for the rest of the year, because I'm going to go on vacation, I don't want to be bothered, right? So after Labor Day, I'll come and check on this baby. And if I went to the $40 call, well, they want money. Yeah, so it probably is going to go. But for $5, you're at $40 a share. And how much more to go to Christmas time or January? You want a full 1-year option on it for 45? Yeah, 585. I'd throw another 85 cents in. And I would go out till January and I'd say, call me. Well, no, it's actually 7. I'm sorry. Yeah, because that's a different strike. Yeah, so if you did the 40s for September, it looked like you got to put up $5. Now let's go back to the chart, and it would be unbridled potential. Let's see what unbridled could take you to if it really got moving.
Yeah, and this could be of course, this is a random symbol we just picked, but this is an example of how
like
some of our long-term plays are set up. With longer-term expiration date, and if you're right, hallelujah, and of course, if not, then you made this very speculative home run play potentially at a reasonable price, and the next one may play out.
Yeah, and the reason we're picking that number is if this thing is for real, and these averages are turning up for a reason, and they're going to start announcing that they just got a whole bunch of business coming out of the hyperscalers. I don't know what these guys do for work, but if they're a software company, those are the guys that are going to make money. IGV is the one you want to keep an eye on, not SMH, IGV. And so, this is a potential home run. And if you went out to September, you just have to figure out how to make $500 the rest of the year to pay it off if it doesn't work out.
Yeah.
Pretty cheap.
Jim, 2 quick symbols and maybe just quickly CLS and then CEG afterwards.
CLS?
Yes.
Celestia?
Yeah. So maybe just from a technical point of view.
Now this one's on the roll here a little bit. It's already in the ozone. Yeah.
Yeah, very extended.
Well, this is this is like the Space Needle over there in Seattle. If you wanted to buy it, they give you a nice opportunity here. But if you didn't take the opportunity here next to the red line, what you've got to do is you got to wave to the people and say, enjoy the Bahamas. I'll be on the next boat when you've come back for me. That's the way I would do it. That's, those kind of things I don't get involved in because they are so already gone. And in the aftermarket, they're already down $3. So if you bought them today, you're already in the soup a little bit. Not a great company, probably. I just don't know I don't know where it's going. I do know it's already gone. So can we find something that hasn't moved yet as much?
What about CEG, real quick?
Oh, well, we love CEG because we had it on the list at, I think, 270. Then it went up to like 400 almost. Obviously, you could blow it out. And now it went back down. But I thought that this was a long-term play at 270. And you'll see why. You see when it came back down here and it was on the green line and all that stuff. That's when I thought it was a good long-term play because apparently they deal in the energy that the data centers need. And according to Larry Ellison and Trump, we're going to be building 19,000 of these things. And so they're going to need energy, and these guys have it. So made a good story. And obviously, when it came way down here, that was the greatest time to buy it. But then again, when it was over here, another good time. And now it looks like it wants to get back on the bicycle, and a big gap to fill. The story is going to be if all you say is true, like Phantom of the Opera, I hope all you say is true, because if it is, this stuff is going to fly because there's nothing but demand ahead of these people. And they're already in bed with the Amazons and the Microsofts. So they're with the big players. So this should be a great deal. Now, what won't be a great deal is if they don't build all the data centers, if they find out that the AI stuff doesn't work as well, and they're not making money on it, or something occurs to, shall we say, undercut the business. Because that's why it dropped. DeepSeek. That drop there? Just spell it, DeepSeek. Because if something like DeepSeek goes around and they tell you you don't need the data centers, then this thing is going to go back and start trading along the trend line like it did for so many years before it became a data center supplier. So, yeah, I think we had it down at 270. I was more than happy to play ball. You got an opportunity when DeepSeek came out, and now it's back on the bicycle.
Great, yeah. Well, thanks, Jim. We also had NVIDIA, but I believe we already reviewed it a bit earlier, so that's
Well, NVIDIA is pretty clear. As long as it holds 113, 115, you're good. If it gets above 130, you're on your way.
Yep. Perfect. All right, so I'm gonna grab the screen one more time back here to address any last-minute questions. Just give me 1 second. There we go. All right, so just to recap, once again, so for those of you who are on board, welcome on board. You're going to hear from me very soon. You should already have the Options Masterclass in your inbox right now. And of course, this is available for both the monthly and the quarterly option. But if you want the 1 hour free coaching, pick Jim's brain, then you would need to use the quarterly option. So this is a great value, but also, staying with us for a full quarter will really unfold the true benefits of the option alerts, because volatility is going to come around. It's going to come around next week. We don't know. But if you're on the quarterly, chances are definitely much higher that you will have one of these amazing trades, which we have shown you before. So it's more of a long-term investment, but I guarantee you, and all the clients that we have, they are very pleased that they're staying around for the long run with us. All right, so once again, tradingindicators.com/alerts if you want to take advantage of this offer. All right, so one more thing to say is that should we have missed out a question, I tried my best to answer all your questions throughout, but should we have missed out, no worries. You can always reach out to us via our homepage here at tradingindicators.com. Go to the main menu, click on the contact item. This will open up a contact form, put your question there, and it will go straight to my inbox. And if need, I will forward this question to Jim for any option-related questions. If it's related to our subscription service, I will answer it, of course, myself. So this is always possible. And just one more thing, the recording will be posted on our YouTube page very shortly. probably in the next 2 hours. So please look out for this. If you missed anything or you had to step out, I know we're already in 1 hour and 30 minutes now. It's been a long webinar. So if you missed anything, check it out. Check out the recording on our YouTube page shortly after. You will also receive a reminder of the recording in your inbox in the next couple of hours or perhaps tomorrow morning. With this, I'm going to say thank you so much, Jim, for being here with us today. It was, as always, a pleasure to have you. And for all others out there, I hope you consider our offer. I think it's a great deal. And I personally am a user of these option alerts. I think they're awesome. So the 2 trades I put on myself this Monday to be working out very nicely, and I can't wait for the next ones. So thanks, Jim, for this. Thanks for putting this together for all of us. And yeah, with that, happy trading. Stay safe, trade safe, and talk to you soon. Thanks, Jim.
Thank you, Daniel.
Bye-bye.